In small and mid-cap stocks having largely corrected, it's time to be constructive now. The market is acknowledging the excesses built over the past year, and with the recent correction, many of the frothier pockets have been taken out. After a long time, value is emerging in pockets. The recent correction has seen India's small and mid-cap stocks experience their sharpest fall since COVID, with broad-based declines of 20% and deeper losses in sectors like media, energy, and metals. Individual momentum stocks have seen cuts of up to 50% in the swift sell-off this year. Multiple factors are behind the recent downturn, including election-related uncertainties, extended monsoons, a decline in government payments until November, tight monetary policy, and a liquidity deficit. When you look at June and September quarter results, growth for NSE 500 companies was just 2 to 3% on average. Clearly, valuations were sky high and the data wasn't catching up in terms of earnings. The market is acknowledging the excesses built over the past year. But now, with much of the froth removed, there are reasons to turn constructive. For the first time in a long while, the central bank is stepping in, both on the monetary and liquidity front, noting that RBI's measures, including open market operations and forex swaps, are pushing liquidity into neutral territory. This is a positive for banks and the broader economy. Additionally, after 5 years, RBI has begun a rate cut cycle, a move that is very, very good news. High interest rates had been hurting private capex and consumption, and easing financial conditions should provide relief. Government spending, which had been sluggish through November, rebounded sharply in December with 1.7 lakh crore rupees spent in a single month, turning the fiscal trajectory positive at 1.8%. For the government to meet its revised capex target, spending in January to March must grow at 20% year-on-year, implying a sharp acceleration. Corporate earnings are also showing signs of improvement. The third quarter results were stronger than the first 2 quarters, with NSE 500 companies posting earnings growth of 8.5 to 9%. While FY26 earnings estimates may still need to be revised downward, consensus expects 15% growth, while Tibrewal projects 11 to 12%. He believes the trajectory is improving. High-frequency indicators signal a pickup in economic activity, he added, citing rising demand for cement, steel, wires, cables, batteries, GST collections, toll revenues, and electricity generation. The Reserve Bank of India has also projected fourth quarter GDP growth of 6.6 to 6.7%, reflecting a strengthening economy. We expect fourth quarter FY25 and first quarter FY26 numbers to be far better than the past 3 quarters. Many opportunities are now emerging, and this is the time to accumulate as stocks shift from impatient to patient investors.